Hi, I'm Bob Karr, founder of Link SV. Today I'm having a conversation with a good buddy, Angel Orrantia, who's the founder of I2I, which stands for Idea to IPO. Angel's created a unique and proprietary process to help startups raise capital. Capital from angels, angel groups, micro-VCs, family offices. And at Link SV, we've been tracking capital for years, angel capital, VCs, corporate capital. So it's a great opportunity for us to partner with Angel in helping these startups. So Angel, we're good buddies. Let's get started talking with your background and how you came to forming I2I.
Sure. Thanks, Bob. I appreciate the time. So as Bob indicated, I'm Angel Orrantia. I'm the founder of I2I. My background, I actually started my career out of Stanford as a design engineer with Intel doing chip design. And then I moved over to Medtronic where I developed implanted medical devices. In fact, my dad's pacemaker is the first product that I developed while I was at Medtronic. Also, while I was at Medtronic, I went to business school at Arizona State. After I finished business school, I joined Philips Semiconductor, where eventually I became the broadband president or the president for the broadband division. I was moved out to Singapore to grow the enterprise. We grew from $7 million a year up to about $300 million a year, a little over 300 employees. And then unfortunately, the .com bubble kind of ruined all the fun that I was having in Singapore. Philips was sold to NXP, and I punished myself by going to law school. I attended the University of Notre Dame in South Bend almost exclusively because they gave me the opportunity to spend my entire second year in London, where I focused on international IP comparative law. After law school, I came back to the Silicon Valley to practice with a regional firm called Fenwick & West that's almost exclusively focused on the high-tech industry. I was staffed on the Cisco deal team, where I consummated about 28 acquisitions for Cisco. And I also got my first training on how to negotiate documents, financing documents with Series A and Series B investors into early stage startups. Then another market shock kind of ruined the fun that I was having in corporate America. And I was asked to move over to IP litigation, where I defended Hewlett Packard and Apple against patent trolls. I did that for a little over a year and a half, which is about all I could tolerate. And then I joined Applied Materials as employee number one to build a materials division. In that role, I did 17 acquisitions, mostly company acquisitions, but a few assets as well. But I started a little internal incubator while I was at Philips or at Applied. That incubator is still in operation today. It's modeled heavily after the Cisco spin out, spin in model. I took that concept and pitched it to the chairman of SK Holdings in Korea, who gave me access to the balance sheet and operating expenses to build and run a core technology accelerator. So I did that at the end of my 7-year contract with them. I had personally led 7 investments. They were doing exceedingly well. 5 of them are still in operation today. They've gone on to raise an aggregate of over $1.5 billion. I took that track record and with a few of my friends started my own VC firm. That's actually how I met Bob. We were targeting a $150 million raise. We had $50 million committed. And then unfortunately, the politics in the country were kind of replicated inside of the partnership. And we went in very different directions. From then until now, I kind of jumped to the other side of the table, and I've been helping early stage startup with corporate strategy services, which really boils down to helping them raise capital or prepare for an exit, either an acquisition or an IPO. So that's kind of my background in a nutshell.
Well, great. Let's get talking about the program now, because it really interests me, and I've already talked to other people about it and getting a nice indication. So let's share the good stuff.
Sure. So when we raise capital, we use a 3-pronged methodology. It's all AI based, or not all of it. It's mostly AI based. The AI that we use is developed here at Stanford University in the neurobiological department. The way that works is it creates a 2,000-point psychographic profile of the ideal investor. Then we can use that profile to find matching investors on LinkedIn and in PitchBook. So on LinkedIn, one of the challenges that we have is angel investors, certainly the ones that we want to reach out to, rarely self-identify. So we have another AI that will go out and check their slime trail. So it'll check postings that they've had on pretty much any social media platform that you can imagine, but the big ones would be Facebook, Instagram, Twitter, or X, or any other social media platform. And what it's looking for is verification that this person is an investor and they invest in the client's space. Once we have that verification, we have yet another AI. This one has been patented. What it does is it consumes the pitch deck of the client's deck as well as the investor's profile, and it creates an introductory paragraph that we can reach out to that's highly personalized. And it's personalized because it's going to create a nexus between something that the company has in offer and something from the investor's background, experience, or postings. Once we have that, then the rest of the campaign is a more traditional email marketing campaign with some sophisticated trees and automations that we've built in to kind of provide some reminders to the investors on that lines. The other thing that we do is we have a proprietary database of 1,800, a little over 1,800 angel groups, micro VCs, and family offices that only accept online applications. We submit somewhere between 600 and 800 applications on behalf of our clients for each campaign. And that process is almost exclusively manual. There's a little bit of automation that we can improve the efficiency with, but it's primarily a manual process. And then the final thing that we do is we reach out to investors via email. The investors we find are sourced from PitchBook, Crunchbase, AngelList, or any other kind of database that we can find. The key is that we still use the AI that creates the 2,000-point psychographic profile. The reason we use it is that it allows us to rank order the investors from the most likely to invest first, and we work our way down the list until we've raised the amount of capital that our clients require. So the service is offered on a month-to-month basis. And after the second month, we can tell with pretty good accuracy about how long it's going to take for the campaign to close, if we're on the right track, or whether we need to make some substantial changes to get on the right track. The system was predicated on one very interesting statistic that only applies to angels and seed raises. And that's because if you're raising for an equity round, those are usually bespoke sort of campaigns. You find out the investors that you want on your cap table, and then you use your network to create warm introductions to those investors. In the seed and angel category, that's not possible because for every $100,000 of capital that you want to raise, the industry averages show that you need to make contact with 100 investors. Right now, the round that closes the fastest and the one that we run most commonly is a $2 million safe note round with a 20% discount. With that kind of round, you would need to make contact with at least 2,000 investors just to be on par with what is average in the industry. What we've done with our system is we've created a way that we can reach out to those 2,000 investors within the first 2 months, and then we just keep the campaign open as long as we need to round out the rest of the capital the client requires.
Well, Angel, I'm just thinking out loud that I've done a lot of angel investing going back to the mid-'70s, and I've never been involved in an angel deal where there was an organized raise, and of course it's way before AI and before all this, the internet and so forth. So I'm naturally intrigued with this, but I want to maybe talk for just a minute about the results you've had and deal sizes, some various things about this that will help people have a little better understanding.
Sure. Yeah, so as I mentioned, the campaign that we run most frequently right now is the $2 million fundraise, and that's because if you read the industry averages, that's the round that's closing the fastest right now. And things are so tough that unless my clients have a very good reason why they don't need $2 million, that's kind of the round that we're going after. But I do have several clients that are running campaigns that are as high as 5 million and as low as 1 million, even in today's environment. And that's because those are the specific amounts that those startups need. And we're not trying to come up with a spend plan. They already have their spend plan pretty well set. So that's the round that closes the fastest. We've run rounds successfully from as low as $100,000 up to 55 million. It really just kind of depends on what our clients are looking for. In very specifically in the seed and angel category, the largest round that we've been able to raise has been $7 million. And that was for a materials company that actually needed to build a factory. So they did not have an opportunity to try and raise 2 million and then go out and raise another 2 or 3 as they were going along. They needed $7 million just to get started. It took us about 8 months to be able to raise that amount of capital, especially because it was a pre-revenue company at that stage. But we were able to successfully raise the full amount that they were going to require, and they're in operation today.
Well, you and I have been talking for quite a while about working together and the excitement of doing all this. And I was thinking out loud with all the questions I've asked you. So maybe you could share, for example, when you started raising. I know you maybe done 53 deals or something. Let's have a little bit of the breakout of that activity would be good to share, I think.
Sure. Yeah. So I kind of started this business in 2017. And at the time I was a solo. I was exclusively using LinkSV to do all of my investor research. And the reason I was using LinkSV is it was very good at I could search for early stage startups that kind of matched the profile of my client, and I could see who their angel investors were. The challenge that I had was that there was not good contact information for those investors. So I know who the investor, I would have the investor's name, I would have who they invested in, but I would spend a lot of time just trying to make sure that I found the right investor to try and make contact with. The AI system that I found a few months after I started this, so I did about 4 or 5 campaigns, purely manual, as I just described. And they were successful, but it was very, very painful to actually pull off because it was just myself. So, for example, using the AI system, I can reach out to 100 investors on LinkedIn on a weekly basis. When I was doing this manually, I was able to reach out to like 20 on my own. So that really helped me increase both the number of clients that I could bring on as well as the success rate, because I was able to just reach so many more investors. Since then, we've gone on to raise capital for approximately 50 organizations. And I would say that in that, we're at about 50% of raising some money for all of our clients and about 30% success rate in raising the full amount that our clients are looking for.
So again, we talked about what happens to people who don't raise any money with you. And I was thinking about the fact they get a prospect list because you're contacting all these people. So just want you to chat about that for a minute.
Sure. Well, whether you're successful or not using the system, one of the things that ends up happening, and we kind of intentionally build in a certain amount of this into the system, but we will intentionally reach out to some people that we're not quite ready for just to start the conversation. So, for example, a lot of the feedback that they'll get is you're not quite ready for us. Come back when you achieve a specific milestone. Sometimes it's come back when you have revenue, come back when you have revenue over a certain amount. Whatever that number is, we'll track that in a CRM that we give to the client. So after they've raised money with us, they already have a preliminary list of people who want to talk to them for their next round. And that list, whether they're successful with us or not, is still going to be applicable, presuming they're able to achieve the capital they need through another resource.
Yeah. Something else that kind of sort of ties into that is that you're not telling people to stop doing fundraising on their own. They should continue to fundraise. And I think, as we discussed, if whatever funds they raise do not count towards your total, you might want to explain that a little bit.
Sure. Yeah, we run purely on a non-exclusive basis. So we get compensated based on the introductions that we make directly. If the entrepreneur or the startup is out and they have other people who are fundraising for them, or they themselves are fundraising for them, we do not impact their economics for the rest of the fundraise at all.
Mm-hmm. Another thing you shared with me was the deal size, the contributions of the investors, of the angels versus the angel groups, and also things that were go-to-market companies versus development companies. You can chat about that for a second.
Sure. So in today's So in 2021, it was pretty easy to raise money, well, kind of across the board, but there was still money available for development projects. We're not seeing that too much these days. So we're not doing too many pre-revenue raises, and we're not doing any raises that are for development purposes. Um, my my profits are all tied to success, so it doesn't help me if I just run a campaign for to try and capture some monthly fees. So usually, so we're not taking pre-revenue companies, and we're not taking companies that just need development dollars, because investors in today's economy or in today's market are only looking for growth deals. So they'll fund companies that are kind of on the precipice of going live or growing their market, but almost all of them want to see some sort of product market proof before they're willing to start investing. Product market isn't always revenue. It could be LOIs or MOUs or something that shows the investor that as soon as the product is ready, there's money available. But for the most part, what investors want to invest in today is growth.
Yeah. As we've begun partnering this together in the last month or so, I've talked to several companies, but I found myself hesitant to talk to companies that I didn't think the business model would be easy to explain over the internet. I think you have some thoughts, but I naturally thought about this. Maybe you could chat about this for a second.
Sure. Yeah. The more complex, the more education you need to give to investors, the longer it's going to take to raise capital. One of the advantages that we have with the AI system is that we can pinpoint target investors that have the right profile to understand what it is that we're trying to promote. But even in those categories, you end up with a reduced investor pool. So the rounds that close the fastest are the rounds that are the easiest to understand. Consumer products are probably one of the easiest things to understand, whether it's an actual product or a service. Then it just becomes a matter of understanding the business model. So the easier it is for the investor to understand the product or the service, and the model that you want to raise money under, or that you're so the model that you're raising under is usually pretty straightforward. It's the safe. But if you're trying any kind of exotic model, it needs to be very easy to understand. And then the model of the company itself needs to be pretty straightforward for investors to understand. If you can accomplish those three things, then you're going to have a pretty good chance of raising the amount of capital that you need.
So thinking about this part of the process, then maybe we could start talking about the process, what happens in the course of the first month, what does it cost for the program, that type of conversation would, I think, and then I'll have some comments to ask along the way for that as well.
Sure. So we have several packages that we offer, and they kind of range from kind of a DIY model where this is where most of my clients actually fit. They come to me, they already have their pitch deck, executive summary, and most of their collateral already created. I'll give them some feedback and some guidance on how to improve it to match our system. Not necessarily that I need to improve their materials generally, but so we can optimize it for our system. It takes us about a week and a half to two to onboard a client, get all the messaging correct, and then we'll go ahead and launch. As I mentioned, we'll usually run the program for at least 2 weeks, and then in like the third week, we'll go ahead and start regular meetings with the client. During those meetings, we'll go through all of the analytics. We can pinpoint, target, how long an investor is spending on each slide in the deck, when they stop reading the deck, those kinds of things. We'll factor all of that into our analysis. We'll constantly be making changes to the deck, to the messaging, and to the methodology that we use to reach out to investors. Then, as I mentioned, by the end of the second month, we'll usually have almost like a tech review for my days at Intel, where we come in and we do a deep dive and kind of look hard at how the campaign is going, how it's performing, what changes we think we can still make, what the trajectory currently is, and we'll make a determination at that point whether we want to continue as is, we want to make improvements, or whether we want to just pause the campaign and maybe try a different methodology altogether.
Sure. So in the beginning of our conversation, you mentioned that you'll probably be reaching out to 2,000 prospective investors, right?
Right. So we can get uh, we're somewhere in the ballpark of 25 to 300 or 2,500 to 3,000 investors contacts within the first 2 months of outreach.
But how many do you start contacting at the end at the end of the first month, like the last week of the first month? Or is it, or
No,
do you,
yeah, it'll take us about, let's just say 2 weeks ballpark
yeah,
to onboard a campaign and launch it.
okay,
So from that point forward, on LinkedIn, we're bound by LinkedIn terms of use. We can reach out
right,
to 100 investors per week on LinkedIn.
right.
The angel group campaign usually takes a little bit longer because there's more materials that need to be put together. So it'll take us, let's say, 3 weeks to put together the angel group campaign. Then we'll go ahead and start the application process. It takes my team 2.5 weeks to finish the angel group application. So those will be like somewhere between 600 and 800 applications. So by the end of the first month, all of the angel group campaigns are usually completed, and we're just waiting, or all the angel group applications are done. We're waiting for the angel groups to start responding. And then on email, we're reaching out to about 500 investors per week. So we can get up to about, but we can't, with a lot of our companies or our clients, we can't just ramp up to 500, or we can't just send out 500 emails because they'll get flagged as a spammer. So we have to start a little bit slower, and we'll ramp our way up to about 500 investors per week to reach out to.
So thinking out loud, Angel, I have about 11 active angel investments myself right now.
Mhm.
And it seems to be a painful process because it's not, you can't take it lightly how much time the company has to spend on raising capital, how much time it takes the CEO or whoever is going to be involved in the fundraising. It's a gut wrenching process and something they don't really want to do. So I think you need to expand a little bit about what you're doing to take the load off of them. I mean, for example, you've got some support people who take calls. You're massaging. Just chat about that a little bit.
Sure.
They don't enjoy the process. Trust me.
Right. Yeah, I don't know that anybody enjoys fundraising, but
Yeah.
one thing that we've done to alleviate some of the pressures that our clients experience is all the first order communications with investors are handled by myself and the team. So, the initial pitch deck that they receive and their preliminary questions are all answered either by my team or by myself. It's only when they start asking the second order questions, the harder questions, that will then request a meeting, and then the founder or the startup team can take it from there. What we've heard pretty consistently from all of our clients is when they walk into that first meeting with an investor, it doesn't feel like a first meeting. For them, it feels like the first diligence meeting, because the investors have already seen the deck, they've already had all their first order questions answered. Really, they're diving into that meeting because they want to start unpacking and start asking some of the harder second order questions. So what I usually tell my clients for that first meeting with investors that come through my service is prepare like a 5-10 minute tops presentation just to reorient them on why you're there and why you're there to have the discussion, but leave the bulk of the meeting available to just answer their questions, because really that's going to be their interest.
Now you've mentioned to me in a prior discussion that you've got a couple of people on your team that are there specifically to take the first level of calls that come in, and to talk about that for a moment, and over to you and to them and passing the baton.
Sure. Yeah. So obviously I've been doing this since 2017. I started building up my team. So I have some people that I've trained that can handle the very simple questions that investors tend to answer. Usually the questions that are already in the pitch deck or in the materials that we prepared for the angel groups. So anything that's publicly available that we've disclosed, my team has been trained. They internalize all that information. So if an investor asks a question that we already have the answer to, they can very quickly answer that investor. And we're geographically dispersed globally. So our investors never sit for more than 72 hours without having somebody loop back around and touch base with them.
So I wasn't going to ask this till later, but touchy. So what if they're not? What if they don't respond at all? Do we have a natural follow-up system so that we go back like at a second wave of sorry we didn't hear from you? Would you like to? what happens
Oh
there?
yeah, no, absolutely. So we'll send them the first email is very carefully crafted, as I mentioned earlier, with the
Yeah,
AI systems and that sort of thing. But then we have a traditional email marketing campaign behind that will continue to, first we'll follow up like every 3 days, and then it'll drop off to like every 2 weeks, and then it'll just drop. We
right.
found that unlike with sales, and we do use the same sort of system to do like
Yeah,
business development, that sort of thing, but with fundraising, we found that sending more than 3 follow-ups is usually not
sure.
going to lead anywhere. But we do want to at least give the investor a few opportunities to engage with us. So we usually do at least 3 follow-ups with them before we decide to move on to our next target.
But I mean, what the heck? I mean, it's a managed process, and I so many things I've been involved with, they didn't have a managed process. It's really difficult, and so the things that you trivialize are actually a big thing and have to get organized. So it's quite a deal. Angel, what experience have you had with business models that are hard to understand to communicate to angel investors?
Yeah. So the easier a product or a service is for investors to understand, the easier it is to find investors. You just have a broader pool to draw from. As your product or service gets more specialized or you need more industry expertise, the investor pool shrinks and it becomes a little bit harder to raise capital. So, for example, when I'm trying to raise capital for a semiconductor equipment or materials company, the universe of investors for that kind of technology or that type of innovation is relatively limited. So it can take us a little bit longer to find the investors that would be interested in that compared to a consumer product that's very easy to understand. It's something that you could see on like your TV or a commercial. Those, because you can appeal to a much broader group of investors, tend to close a little bit faster. Now, the challenge with all of that is that the more you appeal to the consumer centric investors, the check sizes go down as well. So things that are targeted specifically at the consumer industry, those investors tend to like to invest somewhere between $10,000 and $15,000, versus if you're talking about investors that would typically invest in a B2B or an enterprise type of application, most of their check sizes start at about $150,000. So there is a little bit of a trade-off, and depending on where you're going to fit in the industry, you kind of have to balance those things out. Right. Consumer products are much easier to get in front of investors. It's easier to get investors to pull the trigger. But when they pull the trigger, they come in for less capital because they're expecting more investors to kind of join them. On the enterprise and B2B side, there's fewer investors, but they come in with bigger check sizes because they understand that there's a limited universe of investors like them. So if they want to see the project succeed, they need to put in a little bit more money at the front end.
So I didn't prepare you for this question, but what about from your having done like 50 deals? Can you give us an example of a capital raise that went well because the product was easy to understand, and conversely, one that didn't do so well because it was hard to understand?
Sure. So I'll give you an example of a product that at the onset appeared to be very difficult to understand. But when the team tore it apart and we started coming up with like the value proposition, it actually ended up being pretty simple concept to describe to people. So the product that I'm describing right now is Orna. It's a cybersecurity product. It's aimed at small to medium sized enterprises that don't quite have the capacity to have their own CIO. So it's kind of a DIY sort of platform to help you guard your own network. That product, when we initially took it out and started introducing it to people, the story was a little bit too complex. It was tied to a cybersecurity consulting company, and there was some confusion that we were creating between the services the consulting firm could offer versus what the product was going to be able to do. Once we simplified that story and got it really crisp, that campaign actually ended up setting. Right now, it's the campaign that's closed the fastest of everything that we've run, and it was that simple. Well, it wasn't a simple change from that perspective, but simplifying the message really helped that campaign close quickly. Conversely, the field is littered with companies that failed to raise because either their product was too complex to understand, or the way they were describing it was too difficult to understand. There was a consumer-focused company that we were working with that the product seemed really easy. What they were trying to do at a high level was they were going to basically turn your IP address into your mailing address. And instead of having your mail sent to your mail, they could send it through your IP to an IP address, would then get translated back into a physical address. So the description that I just gave you is one of the reasons why it was so hard for investors to kind of grasp. It's just not a simple concept to get through. And the way the team was describing it just never clarified. It never got to the point where if you were in an elevator with somebody and they asked you, what do you do? Or what did your company do? They weren't going to be able to provide like a one-line answer. And if you can provide that one-line answer, it's going to be much easier to raise capital. If you can't provide a one-line answer, if you need a paragraph, or if you need to step off the elevator to have somebody to talk to you so that they understand what you're doing, you're never going to get funded, because that level of explanation is just too hard to get the time with investors to give them that explanation every single time you want to pitch a new investor.
So, Angel, one thing I would like you to elaborate on a little bit is I was interested in the angel groups, family offices, micro-VCs, from the standpoint of onboarding them. I wanted to know about how difficult it is for them to do all these applications, because you had mentioned you have like a common application, so you can go out to all these at one time, I think. Talk about that.
Yeah, so I think what you're referring to is we've developed a database of angel groups, micro VCs, and family offices that only accept online applications. So out of those 1,800, typically what we're going to do is find somewhere between 600 and 800 that our clients qualify for. And we tend to be pretty aggressive. So if there's any chance that we could possibly qualify, we'll go ahead and apply, right? And we'll let the angel group tell us that they don't want to invest, as opposed to trying to do their job for them. So what I would say is what we've done is we've created one giant master application. We've taken all the questions from all those angel groups, family offices, and micro VCs and consolidated them into one worksheet. When that worksheet is complete, then my team uses that to complete all of these applications individually and manually. So far, we have not found a convenient way to automate these applications. Now, there are some tools that you can use for some angel groups. There's Gus, Delum, Procedure, and the list goes on. But even within those platforms, for each angel group, you still have to go in and fine tune your application. So it's not like you're going to be able to just use a shotgun approach and apply to a bunch of angel groups simultaneously. That's technically what we do, but we don't use a shotgun approach. Each application is filled out by hand each time and submitted to the appropriate organization.
Let's shift a little bit and talk about the fee structure for companies to initiate your program.
Sure. So my fee structure is a little bit complex. Since I'm not a registered broker dealer, I have to fit in what's called the VC exemption, which is a little oxymoronic because VCs can't actually use this exemption to help their portfolio companies fundraise, but it's a moniker that's kind of stuck with the industry. Functionally, what that means is that when I help a company raise money, I do so as a member of their team. I do all the outreach from their domain on their email system. They get to keep all of the communications that I have with any investors, should they choose to follow on with them at the next round. The other thing that means is that I don't charge just a set success fee. So the way my structure is set up is early on, I charge a minimum monthly fee that is usually even with the costs. So I do have some hard costs that are associated with my service in terms of the AI tool times and the back office team that helps me manage the volume of data that we create. The success fee, so to speak, is basically a full-time contract that I get with the company to come in as a consultant after we've raised the capital for a period of 12 months. And that is essentially a no-show contract where I have the title and I have the compensation, but I'm not expected to come in and do any of the work because the work that technically I'm being compensated for has already occurred. So the entry level price, which is what most of my clients fit into, is $3,000 a month, and then most of the success fees work out to be about 5% of funds raised in aggregate.
Angel, what differences do you see between serial entrepreneurs and first-time entrepreneurs in terms of adopting your programs and having success?
Well, so it's always much easier to raise money if you have a track record. And surprisingly, it doesn't really matter if you've had a successful track record. If you look at the industry statistics, you have about a 50% chance of success with your first startup, and you have about a 75% chance of success with your second startup. Oddly enough, that 75% doesn't matter if your first startup was successful or not. So a lot of investors are going to favor serial entrepreneurs just because they know that they've been there and done that, even if they were not successful in their first go around. Now that applies here in the United States. It's completely different if we're talking about Europe or other jurisdictions. In Europe, if you're not successful with your first startup, there is a little bit of a blemish that follows you, and getting your next round of capital becomes harder, which is the exact opposite of what we see here in the United States. The other difference that I've noticed is that serial entrepreneurs tend to be a little bit quicker at pulling the trigger to use my service. They know how much effort it's going to be, and they understand that at the seed and angel stage, it's a numbers game, and it's not really about exercising your warm network. It's mostly about just getting your deck in front of as many investors as you possibly can in as short a period of time as possible to create that fear of missing out. So the serial entrepreneurs actually are more willing to sign up with my service, even though theoretically they have a better network than people who are first-time founders.